I am Kim Hughes, and thank you so much for joining me for the Sane Crypto Podcast. If you ask a traditional investment advisor about putting cryptocurrency in your investment portfolio, 99 times out of 100, they are going to advise against it. And 99 times out of 100, it isn't a reasoned response. It is either a knee-jerk response about something they haven't devoted the time to understand fully, or it is because they can't make any money off of it. Because to invest in crypto assets, you have to move money out of the portfolio that they are getting paid on, or it could be both. It's a little bit like asking a surgeon about homeopathic remedies or a lawyer about do-it-yourself wills. I know because I spent over 20 years in the traditional investment world. I cut my teeth as an options trader back in the late 90s and then moved on to financial engineering and building a 2-time Inc. list registered investment advisor firm. So just to be clear, I am no longer any of those things, by the way, having sold my investment firm and retired at the age of 47. So that I could move to my farm in South Carolina to play polo and live happily ever after. Well, that is, until crypto came along. I am probably one of the very few portfolio managers who believe that almost everyone should have a strategic allocation to crypto assets in their portfolio, not just including us old fogies investing for retirement, but especially us old fogies investing for retirement. And on this show, I make the case for why, and hopefully give you some hype-free investment education as part of the bargain. Now, another former investment advisor who recommends crypto assets as part of a traditional portfolio is Jack Tater. Jack wrote the book along with his co-author Chris Berniski on crypto as a new asset class. The book is called, not coincidentally, Crypto Assets. And I had Jack on the show, I'd say, I'll have to look. I think it was probably about a month or so ago. And one part of our conversation that didn't make that show was about ICOs. It just wasn't a fit at the time. It had been sort of a little rabbit trail in our conversation that we went down. But I thought it would be useful background in helping me answer a question that was sent to my Ask Kim mailbox, which, by the way, is askkim@sanecrypto.com. Dina writes, Kim, love your podcast. I've been in crypto just over a year. I own about 8 different coins, all of them ICOs. You seem to be the only person in crypto who doesn't recommend altcoins. Can you explain your logic? Trying to figure out if I'm making a mistake. Looking forward to your answer, Dina. So before we jump right into answering Dina's question, I want to pause for just a quick minute and define some terms that she used. First, altcoin is the term for any crypto asset other than Bitcoin. And that's because Bitcoin was the original. Everything else are referred to as altcoins. Next is ICO. ICO stands for Initial Coin Offering. We're going to talk about this at some length. This is how most altcoins come to market. Much like a company traded on a public exchange has an initial public offering or IPO to raise money from the general public, many crypto assets raise money through ICOs. But not all coins came to market through ICOs. And IPOs and ICOs are very different kettles of fish, as you will hear me discussing in this outtake from my interview with Jack Tater.
one of the things that is really happening here that's very interesting, and is another reason why people should be taking a look at this whole space, is the whole area of ICOs, initial coin offerings. And as I mentioned before, there's a lot of coins that have utilized this platform that are really worthless and are scams. Yes, without a doubt. However, what's also happening here is a lot of the innovation and most innovative developers are using this platform as a way to raise money and build their companies. It has become the new capital raising means for new companies. In the past, it was IPOs and coming into the financial service markets, and you have an IPO, and that's how you get rewarded. Now people are finding the ICO as an option to that. And what we're starting to see is we're going to start to see companies grow out of their funding through ICOs that are going to be very significant companies, potentially companies that will get bought out by other companies, or potentially companies where their coin value will rise significantly. For those people who are familiar with the show Shark Tank, Kevin O'Leary just recently, who's one of the sharks, just recently came to the conclusion that these coin offerings will be the next small cap stocks out there for people, and will be a valid investment vehicle for people to look at, because so much of the innovation is happening with these new companies that are funding themselves through ICOs. So you dismiss this area, you dismiss crypto assets, you dismiss blockchain, and you may not have the ups and downs that we're experiencing here. But in 3 to 5 years, you will find yourself having to play catch up on a lot of these companies that you missed, and a lot of these technologies and a lot of these innovations that you weren't able to take advantage of because you dismissed this whole technology and this whole space. So I think that's another reason for people to be looking at this as well.
Sure. I wasn't planning to go here, but since you brought it up, I'm going to ask, because this ICO boom is something that I haven't been able to get my head around exactly. So I'll ask you, and maybe you can explain it to me, because I really don't get it. As best as I can understand it, an ICO, unlike an IPO, where I am buying shares in a company, an ICO is really almost a glorified, it's crowdfunding. It's a glorified Kickstarter campaign, if you will, where people who are, again, this is my understanding, so correct any of this if I'm wrong. People who are excited in the project are putting money in up front to promote and help facilitate that project coming to fruition. And just as if I was, investing in a drone, only it's a blockchain project. So from an investment, which is all fine, right? But here's where I can't get my head around that investment, because what I understand, as long as it's trading on an exchange and its utility value is going up and I get rewarded for that as a token holder. But in the example that you just cited, where one of those companies is acquired, for example, I have no ownership rights. So how do I, other than just the value on the exchange, which seems pretty tenuous link to the financials of the company, right? You and I come from the old world. Like, how does that work? Can you help me understand that?
Well, your point about it being a glorified crowdfunding is actually pretty accurate. It really is essentially a crowdfunding mechanism. I mean, essentially, someone comes up with a white paper, a concept, and a team of people. And they say, okay, now I need $100 million, and I have this coin, and this coin will do blah, 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 blah. And people throw money at it. It then trades on an exchange, and you're hoping it goes up. And I will tell you, about 8 to 10 months ago, you could have thrown a dart at any ICO that came along, and you would have made money on it. Since that time, most ICOs have come out. They have not gone up. In fact, they've gone down. And in fact, many hedge funds and many venture funds, including my own, we've been avoiding ICOs for exactly the reason that we don't want companies just coming into the ICO market just to raise money. We want them to come and with a very valid business reason and why the coin works for that. So to your point, there is a lot of education that has to happen and a lot of knowledge. Now, that isn't readily available out there. It's really the people who are involved in this, who know how to evaluate an ICO, who know a little bit about the history of ICOs to evaluate this. And for the most part, the regular investor probably shouldn't be involved in this because there are so many scams out there and because there's a real need for education and understanding these things. What's happened is now...
Can I interrupt? But Jack, what do I own? Because, for example, if I'm a venture capitalist who, these deals come to me, then most of the time I'm not buying their coins, I don't think. I think most of these guys are actually taking shares in the underlying company, right, in exchange for their money. But as an ICO investor, what do I actually own? Because these things aren't securities. I can't make the link between, if I own a stock, then that's basically I am buying a share of the future cash flows of the company, effectively, right? But with this,
that's what you think.
Well, that's what you think, right? But at least that's the hypothetical link. But am I wrong? I can't find that link. If one of these companies gets acquired for $1 billion by Amazon, where's the pass through to me, the coin holder? Will I get part of that?
Well, here's a couple of things, and this is one of the reasons that we've stepped back from this, and it's also a big reason why the SEC is stepping in, as they should, because there's a lot of these things that are scams. What's happening now is most of these ICOs are going to accredited investors and not to the regular investor, which is probably a good thing. But let's come back to your question about what do you own. A lot of times with these companies, when they come out, there are situations where venture capitalists will own equity in a company. So a company even coming out with a coin may have some equity. And there are some companies out there, some of the crypto tokens, that have an equity component and a coin component. Now, the equity component may not go to the person who owns the coin. It may go to the venture capitalists who got involved in it. So I will tell you that not all of these companies are just pure coins. Some of these are equities / coin offerings. However, now that being said, it's very difficult to achieve your reward on the equity side until it gets sold. But for those people who have coins, you can invest in the company and immediately, once it's traded on exchange, understand what your value of that is. And should you want to get out of it, you can sell it. You can sell the coin there. Let's talk about your point about if a company does get bought out. Let's say Amazon comes along and Amazon buys out one of these companies. One of the companies out there is called Ripple. That a lot of people speculate may be a company that may be in the position to be bought out. If they do get bought out, then potentially they should still have integrated into their business model a reason for that coin to exist. And this is what we look for, and this is what anyone should look for when they're investing in a coin. That coin should be an integral part of that business. So even if an Amazon buys out a Ripple and it goes over and they pay out all those people who have equity, and now Ripple is now being used, that means that coin will still be used by Ripple, even though it's owned by Amazon, because there's a utility value to it. So now that is being used by an Amazon, the value of that coin is going to rise significantly in value because it's now part of Amazon, because it's now being used much more wider. The utility value for it is much wider. So that's where you would get your value in the value of the coin, because the coin would still sell on coin exchanges, and one of the biggest ones is Coinbase. So you want to make sure it trades on a reputable exchange. But once again, this goes back to the point of evaluating these ICOs to making sure that you're buying into a company that has a coin integrated as a utility into that business. And if you do, and that company gets bought out, and I do think you're going to see this happen in the next few years. If it gets bought out by another company and utilized by that company, that coin will have even more value. So that's where you would get your reward. Is that clear? This is a whole new space. You make a lot of good points. It's speculation. It's not like the old systems that we're used to with stocks and all of those types of things. But it's like I said, we're in the early stages. But that's why when you get involved in these ICOs, you've got to view these in the manner that, and with the skepticism that you're looking at these things as well.
Yeah. Okay. That does make sense. So really, they are two different things, and it would be easy for someone to get to be under the wrong conclusion. For example, I mean, really, what you just said is there's just two components. There's the utility value of the coin. Boom. Mm-hmm. And if I'm buying and selling these on an exchange as an investment, speculative, that's what I am speculating on, essentially, is the utility of the underlying project. And then maybe separately from that, depending on who and what it is, there may be a company underlying that with equity investors and so forth, which is really a separate investment that we're not in as the coin holders. Generally, I mean, there are a few, but generally we're not in that. And that's just, if it's bought and sold, that's a completely separate transaction with separate shares going to shareholders and or equity investors. Did I get that right? In terms of what I said, yes, but that's not something that's universally done. Some companies will have equity. Some will have equity and then have a coin. Right. Some companies will just have a coin. So sure. It all depends. There's really no uniformity towards it, which is one reason I think the SEC is taking a look at this. But when we come in as a hedge fund or as a venture capitalist, and you look at these are things that potentially you want to look at. But for anybody getting involved in the ICO market, you've got to look at the project and you've got to make sure that there's a reason that they have a coin. One of the first things that we do when we look at companies that we're potentially looking to invest in is we ask them, why do you have a coin? And I cannot tell you how many times I've heard over the last 6 months, well, we have a coin because it's an easy way to raise money. And once we hear that, we don't invest in that company. But if the company can prove to us why the coin is an integral part of their infrastructure and why it provides a utility and why it makes them different and why it's needed to make that company work and it has a real good business use case, then you are potentially looking at something that could be a really great investment. And they're few and far between, but they are out there. And I will tell you that this is where a lot of innovation is now happening. It's not happening as much as we think in Silicon Valley. It's happening in these types of companies. Some of them are in Silicon Valley, some of them are not. But there are some real gold mines that are being developed using this blockchain technology and using coins as utilities for them. But they take a lot of hard work to look at. Okay. So just to reiterate, an ICO is a new way for blockchain projects to raise money. And it is backwards fundraising. So traditionally, the way that fundraising was done is an entrepreneur comes up with a product or a service to fill a need or a hole in the marketplace. They establish product market fit. They build out their minimum viable product. They get revenues and profits and hire a team and spend years building the company, possibly raising some capital along the way in various funding rounds. Maybe they start out getting money from friends and family and then angel investors and then finally from venture funds. And then after years of slogging and crafting and honing the product, They filed paperwork with the SEC for an IPO. Having done one of these in a former life, I know that there is a tremendous amount of cost and paperwork. It takes years. There's due diligence done by the Wall Street firm underwriting the offering, not to mention criminal penalties for misleading investors in the prospectus. There is a roadshow where you pitch to investors, institutional investors. And then finally, the day finally comes where the company's listed on an exchange, your ticker symbol goes across the tape for the first time, and your company is publicly traded. When you or I buy those shares, okay, we actually own a percentage of that company. We have voting rights, etc. Okay? Now, an ICO is a totally different kettle of fish, meaning the way it works is the team first publishes a white paper detailing the problem that the team is planning to solve and how they propose to solve it. This white paper, may have the names of some really impressive PhDs on it, or maybe not. But, just to be clear, you can buy a white paper written by a PhD for about $50,000. So that's meaningless. There's really no oversight or due diligence. At the moment, there is no registration with the SEC, although that may change soon, as we'll discuss. They offer these coins for sale as a way of pre-funding the project. Which is really no different than if I want to build a cool new drone and I run a Kickstarter campaign asking people to pre-fund my drone project. If there's enough interest, people think it's cool, they send me money in exchange for the promise of getting my drone when and if I ship it. There are no ownership rights, generally, no guarantees that I will actually ship my project, nothing. And so, I always wonder, well, what could possibly go wrong with raising hundreds of millions of dollars on the basis of a white paper, right? Okay, so when altcoins are issued, whether through an ICO or some other means, there are really two reasons to own them. One is because these coins, in theory, are integral to the working of the project. If I bought Filecoin, for example, which is sort of a decentralized Dropbox, I need those Filecoins in order to transact on the Filecoin network, to store files and or get paid for storing files for other people. Those are what are referred to as utility tokens, and they provide access to the network of the project. And I want to hold them, or I would hold them, because if the project comes to fruition, I think it's cool, like the drone, and I want to use it. Or I am holding them as an investment with the expectation that they will go up in value. With me so far? Okay. So finally, with all that, we have enough background that I can answer Dina's original question about why I recommend against holding any altcoins other than a small allocation to Ethereum. And specifically, just, full disclosure, what I do is I hold a market cap weighted portfolio of Bitcoin and Ethereum, periodically rebalanced. And the question is why? Why do I do it that way? What is my logic? Well, it's very simple, Dina, and it boils down to risk. I believe every single crypto asset that you buy beyond Bitcoin exponentially increases risk without a commensurate reward for that risk. And so this goes back to the Sharpe ratio that Jack was talking about in our interview. With Bitcoin as our measuring stick, as a stand-in for what investors refer to as beta, or the market return on a risk-adjusted basis, in my mind, there are three enormous, largely uncompensated risks relative to Bitcoin, without even considering the fact that I think a massive number of these altcoins are just outright blatant money grabs, i.e. scams, and that there is really no way for a retail investor to know which are which. I don't care how much research you do. It's just delusional for you to think otherwise. So to start off with, okay, before we get to my 3 risks, you are basically playing a game of financial Russian roulette with each coin, and the odds get worse and worse every time you pull the trigger, okay? So you are starting there. And then assuming that when you pull the trigger, you didn't get your head blown off by buying a scam, the real projects have these 3 monumental risk hurdles. They are 1, regulatory risk, 2, what I call wrong wave, and 3, the velocity problem. Now, of these 3, I think regulatory risk is certainly the easiest to understand. Here in the United States, the Securities and Exchange Commission, otherwise known as the SEC, and the Commodities Futures Trading Commission, CFTC, have begun to finally clarify their positions on crypto assets, which is good. On the one hand, the chairman for both, in testimony before Congress, have come out and said that their guiding principle is to do no harm. Again, good, right? In other words, to try not to kill the innovation and the potential benefits that we could derive from this new and exciting technology. But at the same time, that they will live up to their mandate, which is very simply to protect investors from fraud. They have also very clearly said that Bitcoin is not a security and its issuance has not violated any U.S. securities law. On the other hand, ICOs, they have said, are unregistered securities, or at least they were at the time that they were issued, and have therefore broken the law. So, basically every crypto asset brought to market via an ICO has this cloud of uncertainty as to what, if anything, will be done retroactively about that, and, how will that affect the future viability of the project. Okay, so that's 1. Next is what I call wrong wave. And what I'm referring to here is Steve Case's excellent book, The Third Wave, which I highly recommend you read. I think it is immensely useful framework in thinking through the likely path that this technology will take. If you are not familiar with the name, Steve Case was the founder and CEO of AOL, one of the poster children of the internet, and whose millions of CDs snail-mailed to consumers across the country opened up mass adoption of the internet. So reading from Amazon's description of his book, The Third Wave, they say, quote, "The first wave saw AOL and other companies lay the foundation for consumers to connect to the internet. The second wave saw companies like Google and Facebook build on top of the internet to create search and social networking capabilities, while apps like Snapchat and Instagram leveraged the smartphone revolution. Now, Case argues we're entering the third wave, a period in which entrepreneurs will vastly transform major real-world sectors like health, education, transportation, energy, and food, and in the process change the way we live our daily lives." So many of the ideas that I watched crash and burn after 2000 were not bad ideas. They were the wrong wave. In other words, they were too early. There are countless examples, but I'll give you a few. Pets.com, for example, kind of the poster child because of their sock puppet commercials, is the exact same idea as Chewy.com, which was bought last year by PetSmart for $3.35 billion. eToys.com, another flop, too early. They were trying to build a second wave company during the first wave. If Pets.com was the most famous internet bust, then Webvan, which was grocery deliveries, was the biggest, taking over $1.2 billion of market cap down with it. Yet today, we use the internet to have all sorts of things delivered, including food and groceries. And finally, just one more example. Anyone remember the Globe.com? They were the first social media site and also had the biggest public offering, going up 600% on their opening day. Now, of course, by crypto standards, that seems downright pedantic. But the company raised $27.9 million in its IPO. Its market cap was valued at $842 million. Less than 2 years later, in August 2001, the Globe stock was delisted by the NASDAQ for failing to stay above $1 per share. Again, too early, wrong wave. And I just scroll down many of these projects, these blockchain projects, and think, yeah, someday, but not now. This is the first wave, and you are trying to build, or you're at least pitching, building a second or third wave project. It's just so obvious that history is repeating itself. So that's number 2. And then finally, number 3, you have what is known as the velocity problem. And this one is the most esoteric and probably the hardest for non-professional investors to get their brain around. In fact, I think many people, many professional investors even, are just sticking their heads in the sand on this one, knowing that they are playing musical chairs and hoping like heck that the music doesn't stop while they're still in. So I will link to quite a few articles on this. But in a nutshell, the velocity problem says that for most of these projects, the more successful they become, the more they are used, the closer the price will be to zero. Completely opposite, I think, from what would be intuitive to most people. Quoting from an article titled appropriately, On the Velocity Problem for Crypto Assets, they say there is an emerging consensus that velocity is a confounding problem in establishing crypto asset value for single utility tokens. The widely accepted M equals PQ divided by V model, popularized by Chris Berniski, illuminates the effect of velocity on crypto asset value quite obviously. Increasing velocity decreases the value of the asset base in a linear fashion and therefore the price of utility tokens given a fixed token supply. And then they go on to say, as transactional costs and friction decrease, especially as the purchase and sale of these tokens becomes basically instantaneous or concurrent, velocity increases significantly and collapses the utility value of the token. For investors, the uncertainty around this confounding variable should destroy the speculative investment opportunity for the majority of single utility tokens unless they are depending on sustained transactional friction, irrational hodling, or the next greater fool in those token markets. So whether you understood any of that or not, trust me, it's a thing. It's a real big thing. And, to use their word, the confounding thing for me is, given these risks, there is no logical reason for anyone to buy these coins, to buy these crypto assets, unless you just like playing Russian roulette. But, why? A fundamental principle in portfolio construction is never take a risk you don't have to. If Bitcoin is the beta, and it does have risk for sure, but not all these additional risks, why would you own these other coins when there is no guarantee that you will earn more than Bitcoin, and it is almost certainly guaranteed that you will earn less than Bitcoin on a risk-adjusted basis? So, why? Why? This is the thing I don't get. I mean, we're not talking about, a 2% bond investment here that eking out an extra 0.25% is meaningful. In 2017, Bitcoin went up 1,246%, y'all. Like, that's not enough for you? You see my point? I don't get it. I will never get it. I've said this before. I'm going to say it again. This is not some game that you are playing. It's not a competition, with some guy in a chat room. It is not entertainment. If you want entertainment, go to Las Vegas. When you are dealing with having to fund potentially 40 plus years in retirement with the money that you have managed to accumulate, investing is deadly serious business. So be smart, be humble, and the markets will reward you well. Get greedy and the markets will slap your face down into the dirt. That's how it works. As Barry Ritholtz says, quote, "It is the market's job to reallocate money from the ignorant to the intelligent, from the lazy to the hardworking and studious, from the naive to the educated, and from the speculator to the investor." Something to consider, and as always, I hope you found it helpful. Now, if that piqued your interest and you'd like to learn more from me, I would strongly encourage you to go now and register for my free online training, which is called How a Little Bit of Bitcoin Can Make Your Retirement Savings Go a Lot Further. You can register for that at sanecrypto.com/webinar. You will also find the full show notes for this episode at sanecrypto.com/podcast with links to Jack's book, Steve Case's book, some of the articles and statistics I quoted from, and a bunch more. Again, the free online training is sanecrypto.com/webinar, and the show notes are at sanecrypto.com/podcast. And finally, if you have a question about today's topic or anything else, just email me at askkim@sanecrypto.com like Dina did. I read and answer every single email personally, as well as answer some of them here on the show. And speaking of this show, everything I say on this show is for educational purposes only. Nothing should be considered investment advice. Past performance is no guarantee of future results. All investments involve risk, so do not, under any circumstances, invest money you can't afford to lose. That's it for me. I am Kim Hughes. I'll be back next week. Until then, may the crypto gods continue to smile on us all.